For more on the markets and this week's key inflation data, we're joined by Ed Yardeni. He's president of Yardeni Research. Ed, it's good to see you.
Thank you.
Good morning. Ed, just overall, looking at 30,000 feet, seems like the labor market might be starting to ease a little bit, which would be probably friendly for the Fed's proposed action. Inflation also under control. How are you feeling? Sanguine about all these things?
I am actually. I kind of view what's going on in the labor market as normalization. I think everybody's looking at the data and saying it's getting weaker. It's only getting weaker relative to some of the pandemic-related data points that we had a year or two ago. The fact of the matter is, most of the indicators suggest that we're back to a fairly normal labor market where jobs increase by 150 to 200,000 per month. Wages continue to go up, beat consumer price inflation, and the consumer has the purchasing power to continue to spend, which is what drives the economy.
Any eyebrows raised for you when you see the NASDAQ just almost, it looks like a stilt almost, and not necessarily seeing that across the board? Any trouble signs there?
Well, you know, we've both been doing this for a while, and I think we both lived through the 1990s experience. So there's a bit of deja vu all over again when we look at the market and compare it to what happened in the late 1990s. I think the way I would describe things is we're in a slow motion melt up. The market just for the past few weeks has just continued to march higher to new record highs, and it's done it on disappointing economic indicators, because I think investors have concluded that let's not worry too much about the economy slowing or even a recession, because if that were to even become a significant risk, the Fed will move pretty quickly to lower interest rates. I don't think the Fed needs to lower interest rates, but the Fed looks like they're ready to lower them if necessary.
In terms, I think we're going to get earnings starting at the end of this week, and then we'll be, immersed for the next couple of weeks. What do you have an S&P earnings estimate for the next 12 months or so? And what type of multiple would you need to get where we are in the S&P?
Yeah, I think we're going to do $250 a share this year. That's up from $225 a share last year. I think next year we're going to do $270 a share, then $300 a share. By the end of the decade, I think we could be looking at $400 a share. Look, I think Becky just did a really excellent interview with the head there of Corning, and that just demonstrated that the AI story is legitimate. There's a lot of companies that are benefiting from AI. Not all of it's going to turn out to be as magic as being touted, but a lot of it will in fact be so. And I'm looking at during the second quarter for a lot of companies to give us some specific examples of how AI is starting to make a difference in their productivity and cost cutting.
All that said, Ed, do you spend any time losing sleep over how much money we owe, the federal government owes at this point?
I worry about it during the day. At night, I tend to sleep pretty well.
You did melatonin?
Look, we've been doing, again, you and I have been doing it for a while, and anybody who's been doing it for a while can recall that the deficit issue has been a day of reckoning issue for a very long time, and the day of reckoning just keeps getting postponed. So I'm still in that camp that it's a problem. I tend to be an optimist, but I can't put lipstick on that pig. And I guess my thinking is that the day of reckoning will come, and when the day of reckoning does come, there will be a political solution. It's a man and woman made problem. It's not as though we can't at some point come up with a program that over a 10-year period reduces outlays, or the growth rate of outlays relative to taxation, and that taxation has increased somewhat. But for now, Janet Yellen's figured out a very simple way to calm the bond vigilantes down, and that is anytime they worry about too much supply of bonds and notes, she just says, okay, so we'll do more of it in bills, and that calms the bond market down. In addition, the inflation numbers have been great, and I think they're coming down to 2% here pretty quickly. And that, too, I think will placate the bond market.
Yeah, I think we need higher inflation to make the future debt payments less.
That's a really interesting point. They just keep doing more in bills when they can't get the notes.
Right.
That's right.
We've been doing that for a while. That's right.